In 2021, people weren't just buying real estate, they were chasing it. It didn't feel risky, it felt obvious. Prices had been going up for years, rates were low, and every deal looked better if you just assumed things would keep improving. That's what made it dangerous. Because when everything looks like a good deal, you stop asking what could go wrong. Open houses were packed, offers were coming in above asking, and everywhere you looked, someone was saying the same thing. If you don't buy now, you'll never be able to. So people stretched. They took on deals that looked fine, as long as nothing went wrong. And that's exactly where this story starts. Because one of those deals lost $42,000 in just 18 months. And at the time, it looked completely safe. Mark wasn't reckless. He wasn't some gambler trying to flip houses. He just wanted a rental. Something steady, something predictable, something that would quietly build wealth in the background. He found a 3-bedroom property in Texas for $320,000. Clean. Good area. Strong demand. He ran the numbers. Rent, $1,800 a month. Mortgage, about $1,450. Roughly $350 in monthly cash flow. Not amazing, but enough to feel safe. And that's the word that got him. Safe. Because Mark told himself a story. That rents would go up, that the area would improve, that this was just the beginning. $350 a month now, $600 later, maybe more. So he moved fast, 5% down, about $16,000, financed the rest, closed the deal. And for a few months, everything looked exactly how he imagined. But there was something he didn't notice. Something most people don't notice. This deal had no margin. $350 a month sounds fine, until you realize that number isn't really profit. It's a thin line between working and not working. One missed payment, one repair, 1 month of vacancy, and that entire margin disappears. What looks like income is really just a buffer. And in this case, the buffer was almost non-existent. And problems don't show up one at a time. They stack, they overlap, and they always seem to arrive when you're least prepared for them. Because real estate isn't a smooth line. It's long periods of nothing, followed by sudden, expensive problems. 3 months in, the tenant stopped paying. No warning, no message, just nothing. Now Mark wasn't making $350 a month anymore. He was losing $1,450 every single month. And this is where most safe deals start to break. Because people assume income is consistent. But it's not. It disappears. Eviction took 4 months. That's $5,800 gone. And during that time, nothing pauses. The bank still expects the payment. Insurance still needs to be paid. Taxes don't disappear. The property keeps costing money, even when it's producing nothing. But losing rent wasn't the real damage. The real damage showed up when the tenant left. Damaged flooring, broken appliances, walls that needed repainting. Repairs cost $9,000. And none of this shows up in the original spreadsheet. Because when people run deals, they assume average conditions, not worst-case scenarios. But real profit in real estate isn't decided when things go right. It's decided when things go wrong. So before the property even had a new tenant, Mark was already down nearly $15,000. Now most people think this is where the story ends. Bad tenant, bad luck, move on. It's not. This is where it actually gets worse. Because while Mark was dealing with all of this, the entire market shifted. Interest rates didn't just rise, they doubled, from around 3% to over 6% in under a year. And this part catches people off guard the most, because nothing about the property itself changed. Same house, same tenants, same location. But the environment around it changed. And that alone was enough to break the deal. Because when rates rise, 3 things happen at the same time. Buyers disappear, affordability drops, and prices stop climbing. Sometimes they fall. By mid-2023, properties in Mark's area were down about 8%. That doesn't sound dramatic until you run the numbers. On a $320,000 property, that's about $25,000 in lost value. Now Mark is stuck. He can't sell without taking a loss. He can't refinance into a better rate. This is what being over-leveraged actually looks like. Not a dramatic collapse, just a slow loss of options. Every path forward comes with a cost. And when he finally finds a new tenant, even that doesn't go his way. The new rent? $1,650, not $1,800. So now the deal that was supposed to make money is losing money every single month. And this is where most people finally realize something they should have seen at the start. This was never a strong deal. It just looked like one. But here's the part almost nobody talks about. Because there was another investor looking at the exact same property, same house, same price, same market. But they made completely different decisions. Instead of 5% down, they put 20% down, about $64,000. Instead of stretching the numbers, they demanded at least $600 a month in cash flow. And before buying, they set aside $15,000 in reserves. Same deal. Different structure. From the outside, both investors made the same move, same property, same market, same timing. But the outcome was decided before the problems ever showed up. It was decided in how the deal was built. Now when the tenant stopped paying, they didn't panic. They used reserves. Covered the mortgage, handled the repairs. When the market dropped, it didn't matter. Because they weren't forced to sell. And when rents softened, the deal still worked. Less profit, but still stable. That's the difference. Not luck, not timing, structure. Let's break down what actually went wrong with Mark's deal. First, he bought with no margin. $350 a month is not a buffer, it's a gamble. A safer deal, at least $500 to $700 per month per property. Minimum. Second, he had no reserves. Real estate isn't passive. It's delayed problems. You don't see them on day one. But they're there, waiting for the moment when the numbers are tight enough that they actually matter. A basic rule? 6 months of expenses per property. For Mark, that would have been around $9,000 to $10,000, enough to survive the eviction alone. Third, he relied on perfect conditions, low rates, rising prices, strong demand. That's not a strategy. That's optimism, and optimism doesn't pay the mortgage. Here's the reality most people don't want to hear. Real estate doesn't make you money, and because things go right. It makes you money because you survive when things go wrong. And most deals don't survive stress. They survive ideal conditions. That's why two people can buy the same property and get completely different outcomes. One builds wealth, the other slowly bleeds cash. Same market, same timing, same deal, different decisions. Now look at Mark's total losses. $5,800 missed rent, $9,000 repairs, $3,000 vacancy and turnover, about $2,400 negative cash flow, around $25,000 lost property value, over $42,000 gone. From a deal that worked on paper, and remember, he only put $16,000 down. So he didn't just lose his investment. He lost nearly 3 times it. That's leverage. It doesn't just multiply wins, it multiplies mistakes. So before you look at your next deal, forget the best case scenario. Ask a different question. If rent drops 10%, if the property sits empty for 3 months, if repairs hit $10,000, does the deal still survive? Because that's the real question. Not, how much can this make? But I ask us, how much can this survive? If the answer is no, it's not a safe investment, it just looks like one. And that's how a perfect rental turns into a $42,000 mistake.